Every quarter, hundreds of companies announce their results. Some results are in line with expectation, some do not meet the expectation, but sometimes few companies completely surprise the street with exceptional results. But here is the interesting part. Simply looking at numbers does not tell you much. The real question is, what changed inside these businesses that led to such outstanding result? And more importantly, how sustainable is the growth? Because if the growth is not sustainable, stock price can jump temporarily and then fall. Since we have recently kicked off Q1 result season, I've identified 4 companies so far that have delivered solid results. So let's try to understand whether these are one-off results or the beginning of much bigger story. But before we begin, a quick reminder. None of these stocks are buy or sell call. I do not provide stock recommendation. In fact, I strongly believe that nobody can make money from borrowed conviction. You might buy a stock because someone else recommended it, but the moment the stock corrects 20-30%, you will start doubting your decision. Real conviction comes only when you understand the business yourself. So the idea is to discuss potentially strong results, and then you need to deep dive further to figure out if it makes sense to invest your money or not. By the way, there are nearly 200 companies that I'm personally tracking very closely. In every quarter results, I update the Excel tracker with my comments along with discussion in my exclusive weekly video series. I also share my own investment thesis. If I've invested in a company, I'll explain why I've invested. If I exited, I'll explain why I exited. But again, the goal is not to give you buy or sell call. The goal is to help you build your own thought process so that you can take informed investment decision. For more details, you can explore the join button of this channel or visit my website. Alright, let's get started. So first stock in the list is Poonawaala Fincorp. Just look at the results. In latest Q1 quarter, company's AUM has jumped 62.5% year on year, net interest income is up 84% and net profit has jumped 391% year on year. Even asset quality has improved consistently and credit cost has gone down consistently. Clearly the numbers suggest turnaround quarter for Poonawaala Fincorp. But the question is, what really changed for the company? To understand this, we need to go back 5 years. Poonawaala Fincorp was earlier known as Magma Fincorp, an NBFC that was founded in 1988. Company built its franchise by financing commercial vehicles, tractors, construction equipment, SME with a strong presence in semi-urban and rural India. But after IL&FS crisis in 2018 and then COVID pandemic, Magma started facing multiple challenges. Their funding cost increased, asset quality deteriorated, profitability remained weak, and company struggled to generate adequate return on capital. As a result, company gradually lost investors' confidence and its stock price crashed 90%. Then came the turning point. In February 2021, Aadhar Poonawaala acquired controlling stake in Magma Fincorp and renamed it to Poonawaala Fincorp. The most interesting part was the leadership changes. Aadhar Poonawaala bought a completely new leadership team. One of the most significant appointment was Arvind Kapil as MD and CEO in 2024. Before joining Poonawaala Fincorp, he spent over 2 decades at HDFC Bank where he led the retail asset business. Apart from Arvind Kapil, company brought in many experienced folks from HDFC Bank along with other reputed institutions. So instead of chasing loan growth at any cost, new leadership focused on building the right operating platform, strengthening the underwriting, then investing in technology, improving collection, and creating a diversified product portfolio. Today, company offers various product suites, including loan against property that contribute the most in company's AUM, followed with instant consumer loan, then mid-market loan is targeted towards corporates and NBFC, then business loan and pre-owned car loans, and so on. Company has also launched new products including personal prime loan that is targeted towards salaried customer of top corporates, then followed with gold loan, education loan, consumer durable loan, and so on. Finally, technology itself is becoming a growth engine for the company. Management has repeatedly highlighted that companies embedding AI across their sourcing, underwriting, fraud detection, collection, and customer service. With over 100 AI use cases identified and around 50 already implemented. Unlike traditional branch expansion, these investments improve productivity. And as the business scale, earnings grow faster than the loan book. Now, as far as future outlook is concerned, management is targeting ROA of 3 to 3.5 by FY28. Mind you, company's latest ROA is 1.98. So if company can achieve management guidance of ROA in next 7 to 8 quarters, the profit can grow significantly. Now, company's share price did jump significantly after takeover of Poonawaala Group. However, the stock has been kind of consolidating since last 3 years. Its price to book that jumped significantly by April 24 has cooled off to around 3.7 level. So valuations are neither cheap nor very expensive at the moment. But considering the growth potential and management guidance and solid consolidation in last few years, I think Poonawaala is looking very interesting. Then second stock in the list is LG Finserve. Again, just look at the Q1 number. Loan book has grown 82% year on year, operating income is up 100%, and PAT has surprised the street with 119% growth. And more importantly, company continued to have zero NPA. In fact, company has been in a rapid growth spree for last 3-4 years. Now, whenever I see these kind of numbers, I always ask, what is the reason behind this crazy growth and how sustainable is this growth? So LG Finserve is a supply chain finance NBFC. Basically, it lends money to dealers, distributors, retailers, suppliers, and transporters that are part of large corporate supply chain. For example, let's say Asian Paint has thousands of dealers. A dealer needs 50 lakh to buy inventory from Asian Paint. Now, instead of dealer using his own money, LG Finserve finance that purchase. The dealer buys the inventory, sells it over the next 30 to 60 days, and then repay LG Finserve with interest. Similarly, if a supplier needs working capital to supply goods to a large company, LG Finserve can supply that as well. So rather than giving generic business loan, company finances the transactions happening within an existing business ecosystem. Initially, LG Finserve was primarily financing the dealer network of its own parent, that is APL Apollo. Since APL Apollo has one of the largest steel distribution network in India, it gave LG Finserve a ready-made ecosystem to build its loan book. However, over the last 2-3 years, they have expanded to nearly 50 corporate income, including the likes of Tata's, Adani, JSW, Vedanta, Mahindra, where they're financing their dealers, distributors, vendors, and suppliers as well. In the latest commentary, management said that APL Apollo ecosystem now contributes around 1/3 of the overall loan book, and this percentage is expected to reduce further as newer anchor relationships scale up. Now, obviously, 80-90% AUM or PAT growth is not sustainable. In fact, management has also acknowledged that currently company is growing at a very fast rate because it is coming off a relatively small base. It is onboarding new anchors very rapidly, but they also clarified that this pace won't continue indefinitely. For FY27, management is targeting around 25-30% AUM growth with a PAT growth of 30-35%. ROA and ROE are in line with current levels. So even if company can achieve management guidance, it's a solid growth potential. However, one thing that I'll closely track is NPA. At the moment, LG Finserve has zero NPA. And that's because, first, most of the company's loans are working capital loan with relatively short tenure, typically few weeks to few months. Second reason, a large part of portfolio is secured, which is backed by collaterals like receivable, inventory, and other security. And third, management has repeatedly said that they are focused on asset quality first, growth second. However, company is still relatively young and the loan book is growing rapidly. The real question is whether company can maintain better asset quality than peers while continue to grow at 30-40% annually. If you look at company's share price, it jumped exponentially during 2021 to 23 phase and then corrected around 50% from the peak. However, there is again strong recovery and stock is testing its May 23 high. It would be interesting to see if it can cross May 23 level to make a new high. Valuation wise, it is trading at price to book of around 3, which is a decent valuation. Neither too high nor too low. Recently, you would see that management shareholding in the company has increased in last few quarters. Now, this increase is mainly due to conversion of warrant that were issued earlier. In simple terms, it's not a buyback from the market, but promoters are putting more money into the business. Since this is an NBFC, more equity means company can grow its loan book much faster without stretching its balance sheet. That's one of the reasons management has been confident about sustaining strong growth over the next few years. Then third company is Groww. It got listed last year and since then I've been tracking it very closely. In fact, I've discussed it in detail during its IPO. Now, Groww is consistently posting impressive results quarter on quarter. In latest Q1, company's revenue has jumped 63% and profits have jumped 94% year on year. The question is, why is Groww growing much faster than industry? To answer that, we need to understand how the business has evolved. So initially, Groww was known as a simple app to invest in mutual fund. Then it entered stock broking and became India's largest broker in terms of active client. Today it commands 14% market share in mutual fund inflow and 15.1% share in stock broking and consistently gaining market share. But over the last few years, it has quietly transformed into a much broader wealth platform. Today, company does not earn money only from one source. It earns from equity derivative, stocks, commodity derivative, float, MTF, loan against security, and so on. So every time an investor spends more time on platform, the opportunity to monetize increases. Also, company is consistently expanding its mutual fund AUM from 2200 crore to 5400 crore. I think the most underrated aspect of Groww is the cross-selling opportunity. Today, it is already the largest broker in India and is also leading the mutual fund platform race. That gives them a huge customer base of 1.7 crore active user. Now they are launching multiple products and they already have a customer base. So let's say someone started their journey with Groww only with SIP. After a year, he starts buying stocks. Then he applies for IPO. Later, he starts using margin trading facility. Eventually, he may invest in bonds or wealth management product. It's the same customer, but the revenue generated from that customer keeps increasing. So every time an existing customer starts using one or more product, Groww earns more revenue without spending much to acquire a new customer. And that is the beauty of platform business. Your incremental revenue directly flows into profit and cash flow as the incremental cost becomes very low. And that's what makes Groww very promising. The only thing I would keep in mind is valuation. Groww launched its IPO at around 100 rupee and today it has more than doubled from its listing price. And its valuation, including EV to EBITDA and PE, are much higher than its peer like Angel One. Here, please note that even though Groww is diversifying, today more than 50% revenue of the company comes from equity derivative. And derivative business is linked to market sentiment. If F&O volume decline because of regulation or a prolonged bear market, revenue growth could slow. Having said this, there's no doubt that financialization is a massive theme in India and Groww is well positioned to capitalize on this theme with its leadership position in India's capital market ecosystem along with asset-light platform business. Then fourth company in the list is E2E. Just look at the exponential growth in Q1 revenue and profit. Revenue has jumped 334% and profit has reported 44 crore against loss of 3 crore in same quarter last year. Please note that this data is in million rupee. And EBITDA margin have expanded from 29% to 75%. Now, before we discuss the reason behind this exponential jump, let's first understand the business of E2E. So it's basically an AI infrastructure company. Think about it this way. Let's say a startup want to build an AI application. Obviously, it needs high-end GPU. Now, buying these GPU costs crores of rupees. So instead of buying them, companies can rent GPU computing power from E2E. So E2E owns the AI infrastructure and its customer pay to use that infrastructure on demand. Now the obvious question is, why its revenue and profits have suddenly exploded? Basically, there are four key reasons. First reason is GPU monetization. For the last 1 year, E2E has invested heavily in GPU infra. Earlier, a large part of this capacity was getting deployed, but now the same GPU are getting utilized by customer. Second reason is AI demand. Almost every AI startup and enterprise today needs GPU computing power. Very few companies can afford to buy hundreds of NVIDIA GPUs themselves. So they try to rent computing power from companies like E2E. Management has repeatedly highlighted that AI cloud demand continues to remain very strong. Then third, and probably the most important, is the jump in exit MRR. If you look at the presentation, exit MRR has increased from 374 million rupee in March to 718 million in June. Now, MRR is like a forward indicator. It tells you what monthly revenue the company is exiting the quarter with. So exit MRR says that Q2 revenue could be even higher if this run rate sustained. And fourth reason is operating leverage. Building an AI cloud requires huge upfront investment in GPU and data center. But once the infrastructure is in place, every additional customer does not increase the cost proportionally. Having said this, please note that E2E business has various risks. First of all, it's a capital intensive business. It requires heavy investment in GPUs. So if demand remains strong, that's great. But if demand slows after they've already invested heavily, return on capital can fall drastically. Another risk is that GPUs become outdated very fast. That means E2E has to continuously invest in newer hardware. If they don't upgrade, customer can shift to competitors that are offering the latest GPU. Now if you look at the share price journey of E2E, it simply exploded during July 23 to November 24 boom. But then the stock tanked nearly 60%. However, there's a sharp recovery recently from January lows. But here please note that currently there's 5% circuit for the stock. Since it's a small cap stock with limited liquidity, during good times, it can hit upper circuit consistently and during difficult times, it can hit lower circuit. So that can make the entry and exit difficult. Valuation wise, it is trading in a different orbit altogether. So I won't be able to comment on that. Basically, E2E can be considered a momentum stock. One interesting aspect of its public shareholding is L&T stake. It invested in December 24 and today it holds 18.45% stake. Although FIs have no exposure and DI holding is limited. So these were the 4 companies as of 21st July that surprised the street this quarter. But as an investor, I don't think our job is to get excited every time a company report 100% or 200% profit growth. Our job is to understand why those numbers have come. Is it a one-off event or has something fundamentally changed inside the business that can sustain for the next 3 to 5 years? Because if you can identify those businesses early, that's where long-term wealth gets created. At the same time, don't ignore valuations. A great business does not always mean a great investment. Sometimes the market has already priced in all the optimism. So while analyzing quarter results, always look at 3 things together: the quality of business, the growth runway, and the valuation. As Q1 results continue to come in, I'll keep a close eye on important companies and discuss them in my weekly series. If there is any company whose result you would like me to discuss, let me know in the comments. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.